Alright guys, welcome back for another video. Today's video will be a little bit of a macro investing idea video as well as psychology. Basically this quote can summarize my investment view, my different base cases for investment theses. If you guys aren't familiar with Wayne Gretzky, he's an all-time great hockey player, and he had this famous quote, that he skates to where the puck is going to be, not where it has been. And I think there's a lot of great carryover into, the way you view investing and the way you view the narratives that exist in investing, right? You don't want to focus on the narratives that are popular, right? Because those narratives are priced into the market. They're not going to drive the market, right? You want a forward-looking narrative, something that is not common, something that's not popular, and something that is almost inherently going to be contrarian because most people don't embrace it. And that's a little bit different. It's obvious in hindsight, but sometimes it's difficult to recognize that in the moment because narratives can seem very, very powerful, right? As human beings, we are designed as social creatures. And what we value and prioritize in the world is heavily influenced by the priorities and values of other people around us, other people we associate with. So a lot of the way we interact with the environment and the world is based off social cues, which had helped us evolve for thousands of years, hundreds of thousands of years, but it's not helpful in the markets. Right? We need to be able to turn that off, to think for ourselves, to think truly independently. That is one of the qualities that every successful investor or trader has in common. They're all able to form their own thoughts and think independently. And part of that means thinking in second derivative thinking. So by second derivative thinking, I mean, think beyond the current narrative. Where is the puck going to be, right? Not where has it been. And second derivative thinking is basically thinking along the lines of what is happening now, right, as opposed to what has happened. But not only just what is happening now, but what will happen after what is happening now has happened. So good narrative now, currently is, well, not necessarily narrative, but a big event and an important event happening in the world right now is the European energy crisis. Right, Europe is facing a severe energy crisis. The cost of electricity has gone up by 20-fold in France and Germany. And, people are starting to realize that it's, something that, is just becoming a narrative at this point. So some of the things where there might be, a significant degree of edge is thinking on the second derivative effects of that scenario. So as energy prices go parabolic and those supply chains within Europe get disrupted, what are the second order effects? What does that do to the energy markets globally? What does that do to the debt markets? What does that mean for the euro? What does that mean for the U.S. Treasury market? The U.S. Treasury market is another good example. If you guys are following some of my videos, you probably know that I'm pretty bullish on a Fed pivot, meaning a Federal Reserve pivot, injecting in liquidity into the economy. And the reason why is because what's happening in the Treasury market. You have basically the entire world is refusing to buy U.S. Treasuries. U.S. Treasuries used to be held by predominantly, well, not predominantly, but foreign holders held a significant share of U.S. Treasuries. And that has declined very dramatically from roughly 42% down to, I think, 9% at this point. Meanwhile, the Federal Reserve is saying that they're not going to buy U.S. Treasuries. They're letting the U.S. Treasuries on their balance sheet reach maturity and roll off their balance sheet. So you have all these people who used to be buyers of treasuries abstaining, right? Either outright selling or letting their debt hit maturity and not rolling it over. And you also have the energy crisis in Japan and Europe, and that ties into the treasury market as well, because you have these different regions engaging in yield curve control, and one of the major savings of these regions are U.S. Treasuries. So, for example, in Japan, Japan is one of the largest holders of U.S. Treasuries, and they're currently engaged in yield curve control. They have to cap the peg of their yields on their 10-year bond to 0.25%, and one of the ways they do that is by selling U.S. Treasuries. They're further along in yield curve control than the European Union, but the European Union will probably be thrust down that role very soon. They're really already doing it, but they haven't done it at scale yet. But this energy crisis will certainly throw them down that road. And when they get down that road, they'll be engaging in yield curve control, just like Japan, and selling U.S. Treasuries to defend the peg. So you have a lot of different factors contributing to lack of demand in the treasury market. So it's just a good example of second derivative thinking. Of course, we know what the Fed is doing right now, raising nominal interest rates, and that obviously has a negative effect on asset prices in an over-leveraged market. But if you think in second derivatives, you think about the impairment that it's causing in the treasury market, and you think about, okay, well, somebody has to buy U.S. Treasuries or the government's going to go insolvent, right? Who will that person be? Who is the buyer of last resort for U.S. Treasuries? Well, the Federal Reserve is the buyer of last resort. Again, just an example of second derivative thinking. I think that, people may necessarily not dismiss that idea, but they may identify that as a possibility. But I think the possibility of it happening soon or quicker than expected is something that they're not prepared for. And, I think that when that does happen, when the Fed does inject liquidity to backstop the bond market, they will do it very secretively, right? It's not going to be a televised event where they announce that they're, pumping massive liquidity. Because their narrative still is to fight inflation. So if they do inject liquidity into the economy to backstop the bond market, they'll probably do it in secretive ways. One way they could do that is by taking some of the reverse repo market and using that and creating incentive structures to take that multi-trillion-dollar market and incentivize it to purchase U.S. Treasuries. So that way, they're not actually, purchasing U.S. Treasuries. They're just creating incentives for banks to stop parking capital at the reverse repo facilities and use it to buy Treasuries. So it's just a roundabout way of doing the same thing, but to do it secretively. And again, just another example of second derivative thinking. Now, it's not just that one example. This type of thinking applies to to lots of different markets and lots of different scenarios. But to the extent that you can think in this way is the extent that you'll probably be a successful investor, and you'll be ahead of the curve, so to speak. Thinking several moves ahead. Now, that almost necessarily means that you'll be a contrarian thinker, and you'll often be alone in your thoughts and your views. But if you're comfortable being an independent thinker, that's fine, right? It's actually one of the skills we need to be successful at trading. Anyway, I hope you guys like this video. Just leave a like on the video and subscribe to the channel, and I'll catch you guys in the next upload.